Hello and welcome to the latest edition of Citrus Bites from our offices in Sevenoaks. Before I introduce today's wonderful mystery guest, let's do a quick economic update. And I guess there's a couple of questions that are asked most frequently at the moment. One is, have we tamed that inflation beast in the UK? And the second is, well, depending on that, when are we looking at a reduction in interest rates? So as always, let's start with the inflation data. CPI and core CPI, the two that I tend to always talk about on Citrus Bites. Now, the good news is that on a year-on-year basis to March 24, both of those numbers are down. So CPI has come down from its previous 3.4% in the 12 months to February and is now 3.2%. In the year to March, so encouraging. Core CPI has also reduced from 4.5% in the year to date to February and has become 4.2% in the year to date to March. So we start off on a positive going, well, that's great news, isn't it? Inflation is slowing. Here's the catch. First of all, neither of those numbers have got a 2 in front of them, which, as we know, the Bank of England have always said 2%, around that 2% figure is for CPI. That's the goal when it comes to inflation. The second thing is that actually they are still above what Reuters polls had indicated the figures will come out as. So Reuters, who do quite a lot of polling ahead of these results coming out, they were expecting a figure closer to 3.1 for CPI as opposed to 3.2. And also they had polled 4.1 for core CPI against the 4.2. Now, neither of those sound miles away, but unfortunately, obviously, both of the numbers came out above those that are planned. And obviously some way from the 2% target that the Bank of England had previously referenced. And they've always been honest, Andrew Bailey is the governor of the Bank of England. They're looking at data. Data is going to drive this interest rate decision. So a couple of other bits of interesting data that I tend to talk about on Citrus Bites that might well influence the Bank of England when it comes to the meeting that they review. So unemployment. So remember I previously said unemployment is not a great thing if you happen to be one of the people involved in being made redundant, but actually from an economic perspective and interest rates potentially coming down, a slight rise in unemployment is seen as a positive factor when deciding whether interest rates should come down. So unemployment is going up. Unemployment is 4.2% now in the 3 months to the end of February, which is up from 3.9%. So that number is going up. And I'd also talked about vacancies before. So this is the number of jobs in the UK that are going unfilled, if you like. So vacancies has come off again, and it's the 21st consecutive quarter where the number of vacancies has come down. So number of vacancies is down 13,000 to 916,000. So both of those dials look kind of encouraging from an inflation and interest rate perspective. However, drilling beneath the surface tells another problem slightly. So we tend to look at average weekly earnings on this program as well. Well, average weekly earnings in the most recent data are still going up by a larger than expected amount. So on a 12-month rolling, we're now looking at 6% excluding bonuses. And that's still relatively high. And when you think that inflation is coming down, it's really hard to understand why those average weekly earnings are going up at the rate they are. So you've got unemployment going up, you've got the number of vacancies available coming down, but we're still seeing that pressure on average weekly earnings. And when we are seeing that pressure on average weekly earnings, clearly that is something that filters through to the inflation dials. So that's one of the key metrics that the Bank of England do use. One of the other key metrics they use further when they're exploring the inflation pressures are the services inflation. So the UK doesn't produce an awful lot these days. Most of what we do is actually service related, things like hospitality. Well, service inflation is still running at quite a punchy 6% and not the 5.8% that was hoped. So we got these dials sitting below those changes in inflation. The dials, some of those dials are still looking very strong, which is going to make it very challenging when Bank of England are thinking about an interest rate decrease. So the other thing that you may be aware of from the government has tried before is they've talked about the back to work budgets that they've run. So this is about trying to encourage productivity in the UK with people back in work. One of the other numbers that stands out for me when looking at this is 275,000 more people in the 16 to 64 category have become economically inactive over the last 12 months. Now, this means they're not included in the employed or the unemployed statistics, but there's a number of people, and the view is that they are leaving because either they need to become carers or perhaps more of a long-term illness or retiring early. But economically inactive is not going to help the government with their goal to bring people back into the workplace on the post-COVID basis and really drive those productivity requirements that are needed. So definitely a few dials that are causing a concern. And I've had a question that I just want to pick up at this point. So thank you very much. So Michael has raised a question, and Michael, this answer is for you. But Michael's question was a really valid one, which is how much of the 3.2% in CPI is caused because of interest rates being so high? So surely it would be closer to target if people didn't have to pay an extra 30% on their rent or mortgage each month. Thanks for the question, Michael. Great question. So just need to explain, there is another measure that we don't typically talk about in this show, which is called CPIH. So that has kind of household related items in it. And one of the biggest items in CPIH, so we talk about CPI, we talk about core CPI, this is CPIH. It includes something called owner occupiers household inflation. So this is about kind of the direct filter through of mortgage interest rates. So actually in the CPI figure that gets published, that doesn't include a factor directly for increasing mortgage rates. Now, clearly, indirectly it does, because indirectly, less money in people's pockets because they've got higher mortgage or rent to pay for means that there's less money to be able to spend on consuming. So that's the goal in terms of bringing down inflation, but it doesn't include directly the kind of mortgage interest payments. However, even within this other measure of CPIH and the figure I just talked about, so that is running at 3.8% in the year to Feb. However, it's still really hard to try and poll a calculation with mortgage interest rates. So actually, even in this calculation, they tend to look at the actual cost if you were looking to rent the property that you live in. So how much would it cost you on an ongoing basis to rent the property that you currently live in? So even within CPIH, there isn't an exact calculation for mortgage interest rates because it kind of translates it into a rental situation. So Michael, it's a great question. Headline answer, not included in the CPI figure at 3.2 that I talk about. There's a separate measure that takes it into account and actually it translates it into a rental position. So that number is kind of holding quite steady as you'd expect, and in fact has seen a slight increase. Rental income, obviously there's been pressure, there's quite a lot of publicity on rents going up and the amount they are going up. And clearly, if you have a mortgage and you have a buy-to-let property that you rent out, your mortgage payment's gone up and you pass that on through rent. So I hope that answers your question, Michael. Great question. Thank you so much for answering it. Before I go on to welcoming today's guest, there's one other area I want to talk about, which I think is an absolute threat when we're looking at, will we see interest rates start to come down, particularly as we go through to April? There's a definite view, interest rates come down as we go through to June. There's a definite view that into the next month, because of the Ofgem price cap changes, we will see inflation come down a fair bit, and it might even start with a 2. But there is a risk at the moment due to geopolitical tension. And I'm going to talk about, the economic side, not to mention the humanitarian side at this point, but economically, the troubles in the Middle East and what impact that could have on inflation. And what you can see at the moment, I've put up a chart on Brent crude. So the subject is oil. And you can see that Brent crude, which is currently running at about $89 at the moment, has been steadily increasing as a result of the tensions. You can also see on here the top oil producers for barrels of oil and the number of countries in the top 10 that are Middle East based. Well, what's the relevance here? Well, any disturbance in the Middle East, should it escalate further, there is a risk there will be a supply side shock in oil. Now, if you think about supply side shocks that we've experienced over the last few years, think about COVID and the supply side shocks that led to the inflation pressures they did. Think about the Russia-Ukraine war and the supply side shocks that created. And now think about what would happen from an oil perspective. This is a further supply side shock to oil. That does pose a great risk when it comes to the inflation figure. So we're not out of the woods of the UK. I think it's really in the balance at the moment as to whether there will be a reduction in June. A lot of pressure on DARs that are not yet where they need to be, and the added pressure in terms of the geopolitical tensions in the Middle East. So look, I will update again next month in Citrus Bites. It's fair to say, if they're using the data, I think it would be quite challenging at the moment to definitely turn around and say the data is supporting a June reduction. But no doubt, we'll look at it again in May and see what happens then. So that's my headline for today. But I now wanted to introduce today's special guest. So I'm thrilled to welcome today's special guest. Sustainable investments is something that we probably haven't spoken about enough on Citrus Bites, but it's something that from a client perspective, we're increasingly talking about in a lot more detail. So I'm delighted to welcome Gemma Woodward, who is Head of Responsible Investment at Quilter Cheviot. So Gemma leads the Responsible Investment team at Quilter Cheviot, has over 25 years investment experience, and has spent the majority of that time focused on clients with complex ethical and socially responsible investment requirements. So Gemma's specialisms include responsible investments, charity investments, ESG investing, which for those that haven't heard of that term is environmental, social and governance. And that's sometimes referred to as sustainability. So Gemma, thank you so much for joining us today. And probably after having given you all of that introduction, it's probably a good point for me just to stop and go, could you tell us more about your role, please, in a way that our viewers can probably understand?
Yeah, what does that actually mean? So I guess what my team does within Quilter Cheviot is we're responsible for the engagement with the investments that we hold on behalf, of our clients, be it funds, be it equities, fixed income. And it's understanding what are the environmental, social and governance factors that might be a risk or an opportunity to that investment. On top of that, we obviously vote and engage. We're in proxy season at the moment. For those who don't know, that is basically AGM season, and it gets quite busy. We end up interacting with a lot of companies and making decisions about remuneration, about directors. In the US, you have loads of shareholder proposals asking all kinds of things. Some look really useful, others maybe not so much. So that I've kind of got an oversight role over that activity, which, that's a snapshot. The other part of my job is that secretly I work in compliance and regulation, in that we have a lot of regulations within this area that impact companies, asset managers like ourselves. They've obviously got lots of acronyms because we love an acronym in responsible investment, but the Task Force for Climate-Related Financial Disclosures, TCFD, and also the new one, Sustainability Disclosure Requirements, SDR. So I do spend quite a bit of time in that, ensuring that we can embed that properly within the business.
Fantastic. As you said, love acronyms. And Gemma, I think one of the topics we have with clients who are, when we talk about this, they are sat there going, well, I think I do care, but I don't know how to care about that from an investment perspective. And I guess, is there anything from your experience you could help say to people to kind of understand, well, how important is it to someone, and how do they decide whether it's something for them that influences, who they would like to invest their money, perhaps?
I think the first thing, which is incredibly obvious, and you already know this, Richard, is that every client is different. Okay. And I think sometimes what happens is people get put in a box. If they're a bit ethical, they're a bit this, they're a bit that. And I always tell the story of me meeting a client with another investment manager and their advisor, having been told, can you talk to them because they're really ethical? So by the time we started actually digging into those ethics, the one thing that this client actually cared about was fur. Okay. Then sat there and went, gosh, am I a bad person because I don't really care about human beings? We're like, no, this is what really matters to you. And it's about having that conversation, because I think for different people, they will have things that really matter to them. And it's about how you can reflect that, because how you invest should probably reflect your life. Do you know what I mean? You can't be doing one thing over here and then in the other you're doing something else. And I think that's one of the challenges, because it is difficult. Um, and people should feel able to kind of, I guess, be in a safe space. That sounds very wokey, doesn't it? But to actually have those honest conversations about what really matters to them and what doesn't. I think the foundation of it is understanding what your investment manager is doing, about understanding what those risks and opportunities are. How are they mitigating environmental risks within a company? And no company is perfect. Everyone faces these risks, but it's about the management and the understanding of those, I think, is that foundation that you can then build on in terms of meeting those client preferences.
That makes complete sense, Gemma, especially with kind of the recognition that every investor is different, they're unique, different requirements. I suppose one of the questions that does crop up, though, that is more consistent is, well, is it simply a purpose? Am I compromising on profit because of my beliefs and views? So is there a pathway to profitability with this now? Or actually, if someone says I have specific needs, are they immediately a compromise?
I mean, I think that's such a good question, because again, it goes back to what is the specifics of that requirement. So, if you are excluding a number of different sectors, because a lot of clients just like to take the exclusionary approach, that can have unintended consequences depending on what bits of the market you're taking out. So it's understanding what impact that has in certain kind of market cycles. So I would think, if we go back pre the Russian invasion of Ukraine, okay, everyone was raving about ESG funds and companies, which essentially don't exist, by the way, but I can explain that either today or another time if you ever have me back. And, they were performing so well, and we saw all this money pile into ESG strategies. And it was absolutely ridiculous in many ways, because actually what was performing well were growth stocks. Growth stocks tend to operate in industries that score better on a number of those ESG metrics, because they tend to be in more modern, kind of cleaner activities. They're not digging stuff out of the ground like, miners. And my point to anyone would be that, different investment styles all have different times in the sun. So if you want to exclude fossil fuels, for example, because I think that's always quite the go-to in this area, then you should do so because you think it's the right thing to do from a climate change and kind of transition perspective, not because you think, gosh, I'm going to make lots of money about it. And that reason is that then if you're making decisions based on your beliefs, the short-term performance will hopefully be less of an issue to you, particularly if you can understand that it's driven by the fact you're not investing in fossil fuels and not because the investment manager has got it completely and utterly wrong. That's another point. But if you say that, I think people think, oh, it can really impact performance. We've got a sustainable strategy, climate assets. I don't know whether I'm allowed to name drop, but I have. We'll see if they edit it out. And that excludes fossil fuels, but that's outperformed over its 14 years since inception. But that obviously is a long term. And I think, we all think we're long term investors. I mean, I sit on a number of investment committees for charities until we have a really bad quarter, and then we're a bit upset, actually. And then we have a great time, and then we're up again. So I don't think you're necessarily giving up returns, but that will depend on what strategy you're implementing and what impact it has on your kind of, available investments, to be honest.
And that is no doubt a really timely reminder, given obviously my earlier comment around kind of the Middle East geopolitical situation, the impact on oil prices and some of the values we've seen in the oil producers increases over the last kind of 4 to 6 week period. So yeah, a useful reminder. And Gemma, on one of the other bits that I think was felt was with interest rates being higher, to what extent, and some of the responsible investment firms needing perhaps from a growth perspective,
Yeah.
needing access to funds to help their growth, to get this investment to help grow. To what extent do higher interest rates prohibit the companies trying to achieve this?
Again, yeah, absolutely. That's such a great point, because again, because as I, it's a growth part of the market, which tends to be more ESG friendly, does suffer more, as you said, because obviously they need more capital, they can't borrow at those lower rates. And also, I mean, a growth stock is far more focused on the long term. And in an environment where you've got higher inflation, higher interest rates, that just becomes less attractive because it's jam tomorrow and we want our cake today. So that's when it becomes more difficult. So I think, you've got a couple of kind of headwinds at the moment, interest rates being one. And I guess, the political kind of landscape, ignoring, Iran, Israel, etc. But if we're looking at, the US, for example, where you've seen quite a backlash against ESG from a number of kind of the red states.
Yeah, and actually, as you talk, it just goes through my mind just over the scale of the topic, and we're trying to kind of cover it in just a few minutes. And there's clearly, it's so wide and so varied and so different based on different people's views and beliefs. So if I'm a viewer sat here thinking now, maybe I hadn't thought about that quite as much, or now you've mentioned it, actually I want to understand it a bit more. How do I try and get to know more about it?
Well, I mean, obviously, we've got a website where we've got lots of information. Strangely enough, we also, my team does these vlogs. I've never done a vlog in my life, but, called RI Reels. And what they're trying to do, I think probably similar to this, is to do kind of bite-sized, kind of 3-minute intros into different topics, because I think the focus is quite rightly often on climate change. But as you said earlier, there's so many other topics that are really important within this area. So we try and give an insight into those in those vlogs, but there's other providers available as well.
Brilliant, thank you. And actually, therefore, last point from me on it would be, I read something when I was preparing for today. I think KPMG in the US have just literally announced a report within the last kind of 10 days from a survey they've done with a number of US CEOs. And it was really interesting. It said the majority of US CEOs expect significant returns from sustainability investments within the next 3 to 5 years. So this, for me, I suspect, is a topic we would love to talk about more and more on Citrus Bites over the coming months and years. And therefore, I hope that you'll be kind enough to join us again and have the chance to talk more. That would be great. Thank you so much. And Gemma, I can't let you go. The deal, if you've seen Citrus Bites, which I hope you have,
I have,
there's
yes.
a consequence to joining us on Citrus Bites,
I know.
which is you need to answer the question from last month's guest, but you do then get the chance to set the question for next month's guest. So last month, we didn't actually, I was trying to think, it's probably February actually, when Lindsay James, the investment strategist at Quilter, joined us. And her question was, what lesson have you had to learn the hard way, either relating to your career or your investments, that might save the viewers to this some pain?
Many. Been around a while. So I think the one thing that's a real standout to me is a few years ago, not Quilter Cheviot, obviously, I made a move to a firm. And within a very short time period, it became really obvious that the culture just wasn't me. And so I kind of learned from that, and hopefully I can pass this on, is that, one, when I joined QC, I did a lot of due diligence on culture and met lots of different people, and, was kind of like, okay, how does this really work? And, one of the things now when I, with my team, is that as we've kind of hired people, it's being really honest with people who might join, us, about the culture and the environment, and getting them to meet different people. Because I think sometimes you kind of think about what's the role, who am I reporting to, what's my title, but actually where you work and even if you're working from home, the cultural environment is so important. And it's very, people will always give a glib answer about, oh, it's collegiate. But actually trying to understand how it works, to me, is a really important facet.
Great. So I'm hearing culture, and I'm hearing kind of don't be scared to ask plenty of questions.
Absolutely.
I think you're right. I always think whenever kind of we're looking for great talent, you form this sort of psychological contract as you're going through conversations with people that, you know, they just expect that when you say stuff and you make commitments, that when they arrive, that's exactly what they're going to find.
Absolutely.
Yeah. Okay. Brilliant. Thank you so much. And then your question for next month, please.
Okay, well, obviously, the fact I'm slightly obsessed with people using ESG incorrectly. So, my question for the next guest is, what is the topic or phrase related to your area of expertise that gets you rolled up and on your soapbox?
Brilliant. Thank you. I'd love to be able to answer that one myself, but I will save it for the next guest. And Gemma, thank you so much. I really appreciate you joining us. I look forward again to welcoming you in the future. But thank you so much.
Thanks, Richard.
That's it for today. Thank you for watching. As always, really appreciate it. Any questions, please do send them in. I'll do my very best to answer as many as I possibly can as we go through kind of future episodes. But until then, thanks for watching. Take care and bye for now.